Lender's mortgage insurance, or LMI as it's referred to. How does it work? What does it do? Maybe you're a first home buyer and you're facing into this overwhelming amount of information and all this banking jargon that's been thrown around. Let's actually break it down so you're empowered to make the right decisions moving forward. LMI is insurance that protects the lender, not you. The borrower in this case being you were to default on your home loan, and the sale of that property doesn't cover the outstanding loan amount. For example, the bank has foreclosed on your home and you still owe $600,000. However, there's been a downturn in the market, or there's something possibly wrong with the property, and the bank's only been able to sell that property for $500,000. They will actually claim that loss of $100,000 against the insurance company that has provided the LMI. They will claim that loss of $100,000 against the insurance company that's provided the LMI that you have paid for. But remember, things just don't stop there. That's not the end of the story. You're personally liable for the amount of loss, and the insurance company will now come after you for that $100,000 loss that they've paid the bank. So when does a bank actually require LMI? LMI is typically required when a borrower's deposit is less than 20% of the property's purchase price. It allows a borrower with a smaller deposit to access home loans and get into the property market with much less of a deposit. But what's the actual cost? The cost of LMI can vary depending on a base of factors here, considering the loan amount, the percentage of the property value covered by the loan. It's a one-time premium paid upfront or added or capitalised into the loan amount. In saying all this, not all LMI premiums are the same. Have your broker shop around so you're not spending money unnecessarily on this big transaction. Gain an understanding of LMI versus loan-to-value ratio, or LVR. Understand the relationship between LMI and your LVR. A lower LVR, higher deposit, reduces the LMI premium. Saving for a larger deposit to avoid LMI can save you money in the long run. It also reduces the overall interest paid in the life of the loan. But for those who cannot afford such a large deposit, especially in the Sydney market, and to pay the premium up front, there are lenders that will lend you up to 98% LVR inclusive of LMI. This means that you can get into your property faster and settled sooner. Consult with a mortgage broker. Mortgage brokers can assist in navigating LMI options and finding lenders with more favourable terms to you. They can help understand these implications on your specific loan or circumstance. A very important step is to read the fine print. Before agreeing to any LMI, carefully read the terms and conditions. Understand how it works, when it can be cancelled, and any other conditions that may apply, and this is where a broker can help. Remember, LMI is a tool that enables home buyers with smaller deposits to enter the property market, but it's essential to weigh up these costs against the benefits and consider your long-term financial goals. Always, and I mean always, seek advice from a financial professional for personalised guidance. Thanks for sticking through this. I know there was a bit of jargon in there, but I hope you walk away with a high-level explanation here of LMI, and if you have further questions, please reach out or add a comment below, and I'll happily see you next time.